Good day traders, Stacey Burke from Stacey Burke Trading, and today we're going to be just going over the effectiveness of using the 20 period moving average. A few people have asked me why on some of the videos I have a 20 period moving average and then on other ones I just have a blank chart. But I use the 20 period moving average mainly over time. One of the biggest things I learned from studying Al Brooks, if you haven't read Al Brooks's books, Reading Price Charts by bar by bar, excellent books. And one of the key things that I took away from Al Brooks is don't go against the moving average. Now there's a time and a place when we want to potentially trade a reversal. There's also a time and a place where we may trade a pullback around the moving average. But for the most part, I look for some very simple, clear patterns. We talk about support and resistance. We look at rectangles. I primarily always use price first, but I look to always be trading in the direction of the moving average. Now, again, the red bar is the signifies Monday's open, and often again, what I always talk about is knowing where your previous day's highs and lows are, or the most recent highs and lows. And I look for specific times of the day. Now, I don't often trade on a Monday, but that's not to say that if the right setup didn't present that I wouldn't necessarily take a trade. So I will often just occasionally check the charts during Monday. But what I look for is a market that has particularly breached an extreme on Tuesday of either Monday or Friday's lower high, and where the market, we know that again there's three types of situations we look for with markets. There's three types of breaks. The price breaks, it retests, it fills more orders, and then it resumes. The second type of criteria is where price will break, it will fail to hold, okay, like on this Monday's particular case, and then it will reverse, which is what we saw on the Monday this week. And the third scenario is where price will retest, it will fail, and it will go into a trading range, which is sort of similar, I guess, to what we saw on Friday and Monday. But again, price is always trying to break out. And one of the things once it does break out is that we want to try and position ourselves in the direction of that dominant trend. So I know we talk about the opening range of Monday and the initial balance Monday, Tuesday. If we see a market that goes out of balance and breaks, then we know we want to position ourselves into that trend, and we also want to look for the opportunity to see measured moves. So again, when a market breaks out, we want to possibly see measured moves reproducing as the market continues to trend of that original range that it broke out of. So the 20 period moving average can just be a very strong visual indication, especially if you're using the hourly charts. We look for the Asia close, London open. We know that there's going to be some kind of potentially some kind of trap to trap traders, and then whereby again we can look for these transition times into the US Open or into the London Open, where markets will move either back to the other side of that range or again in line with the trend. So if we take a look at here's an example of the pound Aussie this week in particular. So again, you can see where we're using support and resistance in a range bound market potentially can keep traders from getting whipsawed just by merely trading back and forth across the moving average. That's not what we're looking for. We're looking for a market to potentially give us an indication either at a market open or close of where a market could be entered in and trading back to the other side of a range, or where a market does strongly break out. So today potentially we will see a possible breakout as we're starting to see an EMA compression, and we may see a reproducibility of this range of movement right here. Time will tell. So, if we just look at some other examples, and we'll just bring up the euro this week. So we see Monday We saw the market stay range bound, so it broke out on Friday from a range on Thursday. Monday's market breached the lows, but it stayed inside of the EMA. It obviously, here's another example of the EMA squeeze. It built up, it broke out, it retests, built up more orders, and then continued in the direction of that EMA. Now again, we see the market consolidate, gives a blow-off move, goes into a bit of a range, and then in the US session reverses, comes out, retests, and again, now we're back on the other side of this EMA, and we know that the market potentially will want to retest that original breakout from Monday, which it looks like we're now heading towards that now. So again, it's just, this is an example of where you can use the EMA. Now this is heading into the US, the London close, and later into the US session. So again, this is where the market's volatility will usually possibly die down. There was an announcement. But again, so we see the reversal here. That's a fairly large candle. It's a breakout candle. We've talked about breakouts before. If you want to study more of that, read Schabacker's book or Peter Brandt's book, Measured Moves. So again, the EMA is just a way for us to study these markets. We'll look at the pound yen. So again, we see on Monday the market broke out. Actually, we'll just slide that down. Monday the market broke out strongly, consolidated. We had a bull flag. The market broke out again at the open of Tuesday's session, bounced on the EMA, which was also the area the market broke out from. Found support there, and into the US Open, continued to trend. Wednesday the market reversed heavily, broke out of a trading range. So we got a rectangle again. Asia close, London open, boom. Falls down, goes into a range, retests that during the US session London close, finds resistance against the EMA, and then eventually coils and breaks out again. And now we see that market trending up. So again, I don't use the EMA to trade, to make my trade decisions, but I just look for the bias in the market. I want to know, especially at certain times of the day, is that market, two of the questions that Dalton asks in Market Profile. Which way is the market trying to go, and how good of a job is it at doing that? So hopefully you got some value out of today's video, traders. The EMA can be an important tool. So if we just go back and we look at this and we look at the 4-hour chart even, again, you can see that these markets, when they pull back in reverse, there's trading, there's a coiling that will build up for traders to position themselves. The market will then slow down in its momentum, coil again, boom, start to reverse. These can be very, very powerful signals for traders to position themselves with an asymmetrical risk to reward opportunity. Check it out for yourself. Go back and test this. Look around again, Asia close, London open, US open, London close. These can be powerful times to position yourselves with a 1-hour stop and look for 2, 3, 4-hour reward on the trades. Have a great trading week, traders, and may the markets go with you. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.